All right, let's get right to it. S&P 500 futures, the ES, they're nudging up about 0.4%.
And you've got the Nasdaq futures, the NQ, with a pretty solid gain clocking in at 0.7%.
And this is the key thing to watch this morning. Look at the Dow. It's showing just a tempered rise, only up about 0.1% at the implied open.
Right. And that divergence, that gap between tech and, the more traditional value names, that tells the story.
It's the clearest sign we have of this neutral, maybe even conflicted sentiment that's just hanging over the pre-market.
It is. And that mixed signal is so crucial because the market is still processing yesterday's catalyst.
That hotter than expected November CPI report?
Exactly. And you have to remember that report is so much more than just an inflation number. It is the key variable influencing how every single trader is thinking about the Fed's timeline for rate cuts in early 2026.
If inflation stays sticky, that timeline gets pushed out.
It has to. And valuations, especially for growth, they feel that pressure immediately.
So for this deep dive, we're starting with a fundamental conflict. You've got tech momentum on one side,
Driven by some pretty powerful structural stories, yes.
colliding headfirst with macroeconomic uncertainty, which is being driven by that sticky inflation. And we also have to mention the background noise.
And geopolitical stuff.
Yeah, the tensions in Venezuela, that's pushing crude prices around and it's filtering into the energy sector. So with inflation mostly priced in, central banks on the horizon, we're really at a crossroads.
That's the perfect word for it. And our mission today is to define the exact boundaries of that crossroads. Every move, up or down, it's going to need validation.
Validation from volume, from the institutional footprint.
Or it risks being what we call a classic liquidity trap. But before the key boundaries, we have to talk about where the money is flowing right now, because it is definitely moving with purpose.
And based on all the flow analysis this morning, that capital is planted squarely in one sector, semiconductors.
No question.
The narrative is all about strong earnings, soaring chip prices, and this definitive signal of sustained demand from AI and data centers. The market is basically validating the entire CapEx cycle.
It's saying that spending is here to stay. And leading that charge, the top capper is obvious. Micron Technology, MU.
This thing is just soaring. It's up over 9% pre-market.
And the reason is, well, it's foundational. They didn't just have an impressive Q1 earnings report. They coupled it with an absolutely eye-popping revenue outlook.
It wasn't just a beat.
No, it was a structural confirmation of their role in this whole AI boom.
Okay, so for traders watching the tape, the bull case seems obvious. Pure momentum. You're looking to challenge that $260 price level early. But wait. If we agree the overall market is neutral, and there's a heightened risk of a liquidity trap, isn't chasing MU's 9% gap the very definition of the trap we should be trying to avoid?
That's a fantastic point, and that really is the tension of the morning. You're absolutely right. Chasing is always dangerous. But the institutional money, they're willing to take that risk because MU is seen as a structural winner.
Not just a one-day pop.
Exactly. It's not cyclical. It's a necessary component for the future of computing. They're buying the long-term story, not just the gap. Now, the bear case here is purely about velocity. Heavy profit-taking could easily slam it back down to the 235 support level once that initial excitement wears off.
Chasing without confirming the order flow is the fastest way to get burned.
The absolute fastest. Now, moving outside of pure silicon, you've got Lululemon, LULU. It's also up over 4% pre-market.
And this isn't an earnings story. This is a sudden, powerful activist story.
It is. Elliott Management has reportedly taken a stake of over $1 billion.
Explicitly tied to their ongoing CEO search.
Yeah. And that is a massive catalyst for unlocking value. When an activist like Elliott gets involved, it suggests they see untapped potential. They're going to push for changes.
Or push for a leader who can maximize shareholder value, and fast. The immediate target then becomes $225.
Right, if that narrative gets traction. The bear case on LULU, though, is still anchored in the uncertainty itself.
Elliott has intentions, but until a CEO is named or we see their full list of demands, the risk is still there.
Sure, and if those consumer spending concerns linger, which the CPI report definitely didn't help, we could see a retrace back to 210 support. But that activist involvement, it does offer a bit of a buffer against the general market chop.
And we shouldn't overlook the ripple effect from Micron. That's lifting Western Digital WDC.
Benefiting directly. It's up over 3% just on that positive semiconductor sentiment.
WDC also has that other potential driver, the possibility of a business separation, that strategic asset unlocking.
Right, which could be the fuel to push it toward 180. though you've got to watch support, which is sitting down there at 165.
Okay, finally, let's look at the downside, because it's a huge tell on dilution risk. Vision Marine Technologies, VMAR.
Oh, it's a textbook cautionary tale. Tumbled 32%.
And why? They announced a public offering priced way, way below its previous close.
It's brutal for existing shareholders.
Yeah.
It's just a stark reminder that even on a green day, a bad financing decision can just wipe out your capital instantly.
Okay, so let's step back from the single stocks now and look at the macro context, because this is where the short-term direction is going to be decided no matter how hot the semis are running.
These are the gravitational forces. We have to start with the bond market. The 10-year yield, it's eased just a little bit this morning, down about 2 basis points to 4.15%.
But crucially, it's still stuck in that really narrow, tight range, between, what, 4.14 and 4.16%?
It's stagnant. But the key is that it's a sustained high level. That's the challenge.
And at the same time, you look at the dollar index, the DXY, it's up a little, trading near 98.40. Just a slight 0.1% rise.
So it's stabilizing after being under some pressure. And global tech investors, you have to pay attention to that. A strong dollar is almost always a headwind.
Precisely. So you've got a sustained high yield and a slightly rising dollar. For the growth sector, which, by the way, is where all the momentum is this morning, this whole picture leans toward being a pretty significant headwind.
It does. Let's unpack the mechanics of that.
The why. Why does a 4.15% yield hit these high-growth tech valuations so hard? It's not always intuitive.
It really comes down to the simple math of the discount rate. Tech companies, especially the ones in AI or software, their whole valuation is based on these massive future promises.
Earnings that might show up 5-10 years from now?
Exactly. So when the risk-free rate, which is the bond yield, is high, you have to use a higher discount rate to figure out what those far-off earnings are worth today. Higher yields mean future profits are suddenly worth a lot less in the present.
So even with undeniable demand, like with the semis, high yields make the fundamental valuation just harder to justify.
It shrinks their present value. And what about the DXY at 98.40? It's not a huge spike, but a rising dollar still causes friction.
It creates what we call the DXY drag.
Yeah, a strengthening dollar just reduces the value of international earnings when they're brought back home. Think about the big chip makers who book sales all over Europe and Asia.
They convert that revenue back to dollars.
And if the dollar is stronger, the conversion rate is worse. It's a subtle pressure, but it eats away at quarterly margins, especially for those big multinationals.
This whole environment, it leads us directly to the pain trade. If that 10-year yield suddenly spiked, let's say it jumps from 4.15 to 4.30 in one session, what's the trade that retail tends to miss?
And gets caught holding the bag on. The pain trade is an aggressive, rapid rotation out of those highly valued, long-duration tech stocks.
Retail traders are often chasing yesterday's winners.
Of course they are. They're chasing the popular AI names, convinced of this infinite growth. But when yields spike, institutional investors, they don't waste any time. They immediately dump the assets that are most sensitive to rising discount rates.
They sell first and ask questions later.
Exactly. It's like a fire alarm in a crowded theater. You don't stop for your popcorn, you run for the exit. Smart money rotates, and they rotate quickly.
Into what?
Into less rate-sensitive value sectors. Utilities, financials, energy, things that hold up better when rates are high. This leaves the retail folks who bought the high flyers holding expensive tech that suddenly looks very unattractive. And that rotation, that's the rumble we've been hearing lately. A sudden yield spike would make it an earthquake.
That structural risk is the critical context. Okay, let's shift now and define the levels, the actual lines in the sand for the ES and the NQ. Without institutional confirmation at these points, we are just guessing.
Starting with the S&P 500 futures, the ES, our broad market barometer. The key resistance zone is very tightly defined. It's between 68.75 and 68.77.
That's the level the market has been struggling with in the overnight session.
It is, and a decisive close. And we mean a sustained daily close, not just a quick wick above it. A close above 68.77 signals the consolidation is over.
Targeting 69.22, and then you open up that big psychological 7,000 level. And you absolutely have to watch 69.02 as an intermediate hurdle.
Now, for the downside, critical support is 67.65 to 67.78. And this is significant because it was prior heavy resistance.
So basic technicals say prior resistance should now act as solid support.
It must hold above that zone to keep any bullish bias. A sustained break below 67.65 exposes 67.15, and then the big round number at 6,700.
And given that neutral sentiment we started with, the liquidity trap warning here is amplified, right?
Oh, it's a high risk today. You have to watch for the price to pierce one of those levels, say 68.77, and then just quickly reverse course.
Especially if pre-market volume is light.
Exactly. Large players use neutral mornings to sweep liquidity. They fake out directional traders before moving the price the other way. You need clear, sustained institutional participation for a tree breakout.
Okay, turning to the Nasdaq futures, the NQ. The tech driver.
Yeah.
Naturally, it's got the most whipsaw risk. Let's start with that major overhead barrier.
That barrier is 26,000. It's a massive psychological and technical level that has rejected attempts recently. We need a sustained high-volume break above 26K for any real bullish ignition.
Anything less is just a reversal point.
It's a classic reversal point. Now, the support level on the NQ, this carries some unique and frankly concerning structural significance today.
It does, and this is where the caution flag is waving the loudest.
Critical support is at 23,950. This is the danger zone. Why? Because we have a developing head and shoulders formation on the intermediate time frame.
Okay, for those less familiar, why is that pattern such a severe warning? What happens if 23,950 breaks?
That formation is a classic, powerful topping pattern. It signals that the underlying uptrend is losing steam and is, potentially reversing. The whole pattern relies on the neckline holding.
And the neckline is at 23,950.
It's right there. So a decisive, volume-backed break below that neckline. It doesn't just mean volatility. It structurally suggests the intermediate uptrend is over. A confirmed break exposes us immediately to 22,200.
That is a massive directional shift triggered by breaking that one boundary. So the whipsaw risk is high, especially around 26K, but the downside risk is catastrophic if 23,950 fails.
Absolutely. If you're trading the NQ today, patience is non-negotiable. A fake breakout looks like a rapid reversal. Watch for price to pierce 26K on early enthusiasm from MU, maybe. But if the volume doesn't follow, it will snap back, trapping all those buyers who are chasing momentum.
So let's synthesize this for the morning session. The bottom line is that both indices are sitting at a critical crossroads.
That's right. You've got extreme momentum in one pocket, semiconductors, but the macro inputs, that sustained 4.15% yield and the rising dollar, they're pulling like a headwind.
So the strategy directive for the next hour has to be simple.
Patience. It has to be. You have to wait for confirmation, wait for the institutional footprint, for sustained closes, for clear order flow before you commit. The market is giving you mixed signals for a reason.
You have high-flying semis challenging resistance, but the structural integrity of the Nasdaq is being severely tested at 23,950.
Which brings us to the final thought. The trap this morning is to avoid chasing those quick, unconfirmed gap-and-go moves in the hot names.
They could easily be liquidity traps set by larger players who are looking to sell into that retail enthusiasm.
Especially in this kind of wait-and-see market. Trade smart, know your levels, wait for the market to prove its direction before you commit your capital.